we talked about term. What are some of the other policies? You've alluded to them, but can you kind of break those down for us? And how, just at a very high level, how are they different than, hey, I just pay my $20 a month and I'm covered, right? Because people hear insurance, we think of it the same way we think of, our home insurance, our auto insurance. I pay, I'm protected. I pay, I'm protected. But what are some of these other policies where there's additional benefits?
Okay, so we have permanent insurance, and under that umbrella is whole life and universal life. So these types of permanent policies have a lot of living benefits, and that's what we focus on here. So a plain vanilla simple plan like whole life has guaranteed death benefit and guaranteed growth. So we're funding a life insurance policy. A lot of times, people like us, we're young, we're not focused so much on the death benefit. We're focused on the cash value, so we can do something with that wealth, like invest in real estate. So the policies grow through dividends that the insurance companies return when they make a profit. So on top of all those, the cash accumulation, and we have many other benefits throughout your lifetime, like some sort of disability benefits or long-term care that protects your family. But, in a situation with Be Your Own Bank, we're focused on the cash accumulation. And there's a point in your time, there's a break-even point with these life insurance policies that you break even. So the amount of money that you put in the policy equals the cash value. And oftentimes that's, within 3 to 5 years if properly funded.
So walk me through that. If I'm putting $100 in a month or whatever number that is, at some point I'm able to draw from this. Like, break that down for someone who's never worked with a policy like this.
Okay, so we mentioned the word specially designed life insurance. So each situation is different. So if someone comes in and has, let's say, $100,000 to work with, and they want to buy a house with that, we could actually structure a policy that they could put $100,000 in right away and then loan the majority of that money out right away to do that same thing of buy the house. In a different situation, we might have someone that only could put $100 a month or $300 or $500 a month. Their cash values may not be big enough to do something meaningful with in the first year or two, but they could surely buy something small like a car or pay down credit card debt with it. But if properly structured, you have a good amount of that cash value available right away.
So with the $100,000 example, that what they're putting into it is basically paying for premiums for X amount of months or whatever, and that's how they're buying into it. They're not necessarily just putting it into like a bank. You might put $100,000 into a bank account. You're putting it into an insurance policy in the form of. Is that right?
Yes. Again, I mean, depending on how it's structured, you could simply put in $100,000 one time, and then we could set it up so you have monthly payments of $500 or $1,000 or whatever. You have to follow certain IRS guidelines for life insurance, but depending on what your situation, what your financial goals are, a policy could be designed for that purpose.
And in that $100,000 example, where someone's going to win is that they put the $100,000 in, and that insurance policy that's going to pay back a return, I use the word dividend, on an annual basis. They're going to earn dividends off that $100,000 while still using that money as their down payment.
Yeah, uninterrupted compounded interest. So that $100,000 is technically going to work for them for the rest of their life. Okay, and they're able to take whatever cash value that they need for an investment and earn an external rate of return on that investment as well. So that's the whole concept of getting two uses out of each dollar.
Got it. Yeah, the way it was explained to me, and go ahead and correct me if I'm wrong, but this really helped put it in layman's term. If someone had a 401k with $100K in it, and they wanted to take $50K out, whatever, $50K is gone from that 401k. Like, it's out, and you're only earning on what you left in there. Similar to the example you gave earlier. With these type of policies, you put $100K in, you're not taking that 100K out. You're getting basically a loan or a line of credit against that 100K, like against your policy as an asset.
Yes.
Right? Like I almost look at it as like a HELOC. Like this is the asset and I'm able to draw from it, but I don't have to give up my asset. So remember when you take out a HELOC on your house, like you don't have to give up the rents, you don't have to give up anything, it's borrowed against there, and it continues to grow in value just like a house would appreciate even though you borrowed against it.
Yeah. So in that 401k example, when you take money out of a 401k,